Hi, we are back to talk about a few more things you can do with assets. First, we're going to talk about natural resources. So down here in Texas, oil is a big deal. So you can imagine accounting for natural resource oil becomes a huge thing. Of course, in other parts of the country, maybe they have trees, forests, mining, a lot of natural resources people might use. So in Texas, we tend to think of things like oil and gas, but there's other stuff too. So, a natural resource is an asset that comes from the earth and is consumed. Examples include iron ore, natural gas, diamonds, gold, coal, and timber. Natural resources are expensed through depletion. Depletion is the process by which businesses spread the allocation of a natural resource's cost to expense over its usage. It is called depletion because the company is depleting or using up the natural resource, such that at some time there will be nothing left to extract. Depletion is computed by the units of production method. So remember, we did depreciation and we used up the asset as it made things or drove miles. Same idea with natural resources. You're depleting them, right? So you can imagine an oil well that holds a certain amount of oil. As you extract the oil from the ground, you're using up the oil that's in the ground, so you deplete it. All right? So assume an oil well costs $700,000 and is estimated to hold 70,000 barrels of oil. There is no residual value. If 3,000 barrels are extracted during the year, depletion is calculated as cost divided minus residual value, divided by estimated total units. So 700,000 minus 0, because there's no residual value, divided by 70,000 barrels equals $10 per barrel. So every time the company that owns the oil well takes one barrel out, they're depleting that well by $10. So however many barrels you take out, $10 per barrel. So multiply the depletion per barrel by the number of barrels for the period. So $10 per barrel times 3,000 barrels equals 30,000 of depletion per year. So it works a lot like depreciation, but we call it depletion, right? Depletion expense, oil reserves, accumulated depletion, oil reserves. So a lot like depreciation, but it's not quite the same thing. But typically you calculate it on the units that are being used up. Alright, so now we're going to go and talk about these assets that are intangible. So we've talked about plant assets, and we talked a tiny little bit about natural resources, and now we're going to talk about intangible assets. So the final group of long-lived assets is intangible assets. An intangible asset is an asset with no physical form that is valuable because of the special rights it carries. Intangible assets convey special rights from patents, copyrights, trademarks, other creative works. In our technology-driven economy, intangibles are very important. The intellectual property of a business is difficult to measure. Intangibles can account for most of a company's market value, so companies must value their intangibles just as they value other merchandise, inventory, and equipment. So imagine you are an accountant at Microsoft. Well, basically what Microsoft sells is software, right? So because they have those patents to Office and Word and Windows, that's worth a lot of money. Nobody else can sell Windows. Nobody else can sell Excel. That's worth a lot of money to them. So you have to put a value on that. That's a big asset for Microsoft. Way more than probably their buildings or anything else. All right. So what do we do about this? Intangible assets that are purchased are recorded at cost. So obviously, if Microsoft decided to sell the patent for Excel, and you paid them, I don't know, they probably want billions of dollars for that. You paid them billions of dollars, that's just, you just put down the cost, right? So if an intangible asset's purchased, you put it down at cost. If an intangible is not purchased, only some limited costs can be capitalized. Most purchased intangibles are expensed through amortization. Amortization is the process by which businesses spread the allocation of an intangible asset's cost over its useful life. So just like we have depreciation for plant assets, right? We're going to depreciate the building, depreciate the machinery. For natural resources like oil, we have depletion, so we're going to deplete the oil reserves. For an intangible like a patent or a copyright, it's probably on the books for some amount, and whatever that cost is, whatever it's on the books for, yes, we spread that out over time too. And instead of calling it depreciation or depletion, we call it amortization. All right, so how do we figure out how much we amortize? Intangibles either have a definite life or an indefinite life. Intangibles with an indefinite life have factors, such as legal and contractual obligations, that limit the usage of the intangible asset. Only intangibles that have definite life are amortized. Intangible assets with indefinite life are tested for impairment annually. All right, so an impairment is a permanent decline in asset value. Impairment occurs when the fair value of an asset is less than the book value. In other words, there has been a permanent decline in the value of the asset. If an impairment occurs, the company records a loss in the period during which the decline is identified. So this idea that some assets have a finite period of time, right? Like a patent only lasts so long, or that something could become impaired. You can have a patent for something, especially things like, I think of pharmaceuticals, right? Those patents are worth a whole lot. They have a limited amount of time, so you amortize it over that period of time. It's a definite period of time. But they can also become impaired. Impaired means it's not worth what it used to be. So you might have a patent that for a pill that cures some illness, and it's worth a lot. So that's worth a lot of money. So you have it on your books, and you're amortizing it over a period of time. But suppose somebody invents a better pill. Instead of having to take those pills for a year to cure the illness, you take one pill, it's cured. Of course, everybody's going to take that other pill, so now yours aren't worth very much. So you have to impair them. So that's what we're talking about. So we're trying to get the right value of the assets on the books. You either amortize them over time, if they have a definite life, or you impair them when they become worth less. Okay. What kind of intangibles are there? Well, there's patents. A patent is an intangible asset that is a federal government grant conveying an exclusive 20-year right to produce and sell a process, product, or formula. So, when you think of something that a person has invented or come up with, like a new medicine, like a new software, like a new machine, you get a patent on it and nobody else can produce it for 20 years. So you have the rights to that. So that's valuable. That's worth something. So here's an idea. Let's pretend Smart Touch buys a patent. Suppose Smart Touch Learning pays $200,000 to acquire a patent on January 1. Amortization expense is calculated using the straight line method. So we got a 20,000. So we know that you amortize things just like you do depreciation. You take its useful life, divide it by the cost, and you spread that out over the time. So we put it on the book. So this first transaction is when we bought it, right? So patent, asset, increases with a debit, 200. Cash decreases, so credit, 200. So we've put that patent on the books. The second transaction is after a year goes by, we're doing our adjusting entries. We need to record all those depreciation expenses, depletion expenses, all those expenses we need to put on the books. Well, amortization expense for the patent needs to go on there. How do we decide it? Well, in this example, the accounting clerk somebody decides the patent's useful life is 5 years because it is likely a new, more efficient process will be developed. So even though a patent's good for 20, they're going to only depreciate it over 5 years because technology increases so rapidly, so they're going to depreciate it over 5 years. So 200,000 divided by 5 is 40,000 per year. So here's your accumulated expense patent, and patent reduced by 40. Another interesting thing, you'll notice we don't have like a separate accumulation account like we do for plant assets or natural assets. It just comes right off the asset. Next, copyrights, trademarks. A copyright is the exclusive right to reproduce and sell a book, a musical composition, a film, another work of art, or intellectual property. Copyrights also protect computer software programs like Microsoft Windows. Issued by the federal government, a copyright is granted for the life of the creator plus 70 years. So if you write a book and publish it, you get to have the exclusive rights to it for your whole life plus your estate. You can leave it to them for 70 more years. So think about movies, books, things like that. A trademark, also called a trade name, is an asset that represents distinctive identifications of products or services, such as the Nike swoosh or the McDonald's golden arches. The cost of a trademark or trade name is amortized over its useful life. So divide it out, amortize it, and take the money off as an expense. Franchises and licenses. Franchises are privileges granted by a business to sell goods or services under specified conditions. The Dallas Cowboys football organization is a franchise granted by the National Football League. McDonald's and Subway are well-known franchises. All right, so franchise is when you've got permission to use a certain name or brand. All right, so certainly all the fast food places, those are franchises. And it's worth something to be able to use that name. A license is a privilege granted by a government to use public property in performing services. A radio station might be granted permission by the federal government to use the airwaves to broadcast music. The acquisition cost of a franchise or license is amortized over its useful life. So a license means you're the only person in that area who can do this, or you're the only person who can use that wavelength on a radio station. So that's worth money. Nobody else can use that. Goodwill is the value paid above the net worth of the company's assets and liabilities. So this idea of goodwill is another kind of an intangible. And you don't see a lot, but you will see it on some companies' books, but not all. In the first place, to get goodwill on the books, a company has to have been purchased by another company. So it's not something that happens all the time. You can't just have goodwill on your books because you want it. It can only happen when one company purchases another company. In accounting, goodwill is the excess of the cost of an acquired company over the sum of the market value of its net assets. That is, assets minus liability. Goodwill is the value paid above the net worth of the company's assets and liabilities. Goodwill is recorded only by an acquiring company when it purchases another company and pays more for that company than the market value of the net assets acquired. An outstanding reputation may create goodwill, but that company never records goodwill for its own business. So if you're in business for a long time, you may have very good respect of your customers, but that doesn't create the asset goodwill. The only time that asset goodwill would happen would be when that company is sold and whoever buys the company pays more than strictly what it looks like it's worth on the books. They become goodwill. According to GAAP, goodwill is not amortized. Instead, the acquiring company measures the fair value of its acquired goodwill each year. So goodwill goes on the books for a certain amount when it's purchased. And then after that, every year you sit there and you go, well, what's my goodwill worth this year? What's it worth next year, right? So you just so you might change it if you think your goodwill has changed. Exhibit 911 on page 500 summarizes the types of assets and their related expenses. Plant assets are those assets that have physical characteristics and are used in operations. So that's a plant asset, a machine, the factory, buildings, things like that. Plant assets are those assets that have physical characteristics and are used in operations. Natural resources are assets that come from the earth and can ultimately be used up. So natural assets, oil, ores that you mine, diamonds. Intangible assets are assets whose value is not derived from their physical substance. So an intangible is not an actual physical thing that you can touch. It's like the rights to something. It's the rights to use a name, like a franchise. It's the rights to use airwaves, like a license. It's the rights to be the only person who produces something, like a copyright or a patent. All right, so that's the asset summary. Let's talk for a minute about what kind of ratios we might use to examine assets. So just like every other chapter, there's some special ratios that we can use. The asset turnover ratio measures how efficiently a business uses its average total assets to generate sales. Asset turnover ratio equals net sales divided by average total assets, right? So, of course, you're using your assets to generate your revenues, right? So my buildings, my machines, all my assets, I'm using that to generate my revenue, so how well am I doing using my assets? That's the asset turnover ratio. Net sales divided by average total assets. So net sales, as you may recall from when we learned about our income statement, net sales equals sales less sales discounts and sales returns and allowances. Average total assets, I don't think we've really talked about average total assets, but obviously over the course of a year you might buy and sell some assets, right? We talked about disposal, acquiring assets in this chapter. So whatever your beginning assets are, so on January 1, what are your assets? Then at the end, what are your assets? So you add those, beginning assets, ending assets, divided by 2, that's your average assets for the year. And that's what you use to calculate asset turnovers. Net sales divided by average assets. All right, so that takes care of class 28 if you are on Monday, Wednesday, Friday, and this takes care of class 20 if you're Tuesday, Thursday. That was a long one, Tuesday, Thursday, folks. Sorry about that. All right, I will see you in class. Have a great one.